for me, based upon my model, I really am looking for properties that are going to net cash flow every month, just because regardless of what happens, I can weather almost any storm is kind of my underlying theory there. If this is your first deal and this is cut my teeth deal, I don't think it's a terrible deal to get into. Again, make sure you get a property inspection, do all your due diligence and stuff like that. And if I understand your spreadsheet correctly, you're losing 348 a month.
Yeah.
Worst case comes to worst, 5 years from now, you have to refinance at that price point. Equity is great, but equity sometimes can be hard to eat. Welcome to another episode of Deal Destruction. I'm your host, Matt McKeever. Today we've got Ray. He's going to be looking at a triplex that's just outside of Montreal. It looks like about a half hour, 40-minute drive. And it's near a light transit rail or proposed line. So really excited to check out this deal. Hey, Ray, how's it going?
Hey, not too bad. Yourself, Matt?
Doing good. So before we jump into this deal, do you mind just giving us some context? What's your experience with real estate investing up until this point?
Completely new in real estate. Maybe the last few months, I work a daytime job at 9 to 5. Similar to you, Matt, as I used to be a CPA. So that's great. I just want to kind of grow my portfolio out of stocks and kind of go into real estate. I really see it as a great financial, a great way to get the financial freedom in the future. And I just like real estate, so something I'm really interested in.
Awesome. Well, I'm excited. You've shared the listing with me, so I'm going to pull it up here and do a screen share. While I'm pulling this up, so what's the overall goal here, Ray? Is it cash flow? Are we flipping the property? What's the plan?
The overall goal for now would be more of a buy and hold. There is a light rail system that's coming into like 5 or 10 minute walking distance from this place. So that's an opportunity for sure. But in the immediate short term, at least, it'll be more of a buy and hold. If tenants leave, try to get more rent out of the tenants. Any other type of revenues we can get out of it, we'll try. But in the immediate term, we don't really see an opportunity to do a big BRRRR because it's already a triplex. Inside is decent condition from what I understand. So buy and hold for the next few years.
Okay, interesting. Okay, yeah, let's start over here and just talk me through kind of, so it looks like we've got a solid brick house. At some point in time, they've probably put on an addition or two. That's kind of what we're seeing here. Looks like pretty big lot. Is this the entire lot? It's got all this parking?
Yeah, exactly. And that's what I kind of see as an opportunity as well. I mean, as you can see, the lot is probably in 9,000, 10,000 square feet, but the house itself is using half that lot. So, in the future, I'm kind of thinking out loud, maybe we can sell off that parcel of land if the city allows it. That could be a good opportunity in the future, potentially.
Yeah, definitely worth looking into and finding out, was this a double lot? Has it merged? What's the story here? Was it always just a big lot? Because seems like a lot of space, which is great. So then kind of moving along. So is this just showing me the back of the house, and is this the neighbor's backyard, or is this part of their backyard? Is this your backyard still?
Yeah, it's the same. It's the backyard it's all one big piece of land. This is just sectioned off, but it's part of the sale.
Part of yours. Okay, cool. Yeah, this is a lot of space then. Bunch of shitty outbuildings. Now, this is something that caught my eye. This looks like an old oil tank. Is this still a thing? Am I wrong?
Yeah, exactly. So it's a bit of a unique story here, but there's 3 units. 2 of them are on electricity paid by the tenant. One of them, the main unit, is still on this oil heating, but has to be changed within the next 10 years by law.
Okay, I was going to say, I thought they were really cracking down on that. And just in FYI in general, at least in Ontario, I'm sure Quebec has its own rules, but in Ontario, insurance companies are a real pain in the ass about this sort of heat system. So that's something I would just look into before ever going firm, unless I already had my insurance in place, just as an FYI.
Oh, that's good information. Thank you.
Back looks a little bit messy, but looks like this is a big unit overall. It's, one of the things I'll just comment on, interesting that there's no interior photos, but let's check out. So they're saying parking, 6 spaces, at least I'd say. And this is is this the location?
Yeah, exactly. So you can see it's like a little bit outside of Montreal.
Okay, gotcha.
Yeah, I would say it's about, right now by car without traffic, I'd say it's about 35 to 40 minutes away from downtown Montreal, maybe a little bit more. But with a new light rail it's about 5 years away from completion. They've started building it already, but in other parts of Montreal, it'll take 31 minutes to go straight to downtown. And it'll come every 5 to 10 minutes.
Oh, nice. Okay, cool. And then just because I'm less familiar with this because we use realtor.ca,
Right.
is there any other financial data here available for us or no?
If you press right there, it says detailed, need
Okay.
more details. Yeah,
This
there you
pops
go.
out.
Yeah.
Cool.
You see a little bit more information there.
Okay. Let's just quickly check it out. Gotcha. Huh. I actually thought the lot might even be a little bit bigger than that, but it's still a big lot. Oh. Shoot. Okay, and this is where we've got our little bit of financial data. So property taxes at like $6,000, annual expenses, insurance, no removal, not too much, heating. Okay, cool. And so Ray, you've got your own spreadsheet? Oh, looks like you're muted.
Yes, I do.
Okay, awesome. If you don't mind doing a screen share, I'd love to check it out and maybe you can just walk me through it and
Sure.
let's chat through your business plan.
Yes, let me know when you see it, Matt.
Don't see it yet. Have you clicked share?
Oh, I'm sorry. I'm used to using Microsoft Teams more. All right. You see it, my third screen? Okay,
yep.
Perfect. Great. So pretty colorful.
So this is definitely a CPA spreadsheet.
Yeah, you see it right out of the bat. So if any one of your subscribers wants a copy, just let me know. I'll ship it your way. But so what I did here is that I'll go over the mortgage calculation part first and ask you a few questions about it. I have our total price. This is what I'm estimating we could probably get it for. I put here 10% down, but I'll change it to 20%. I think that's a bit more realistic. My tables will update. That's fine. So my net mortgage, I'm assuming a 1.5% annual interest rate because this is what I've kind of been quoted right now. As a first property, I can go to a lender and get that. Now, I know in your videos, I've seen you use 3.5%. And I had a question about that. Is that because you're assuming that's the average interest over 25 years and you're baking that in? Is that the logic there?
Yeah, that's roughly my logic. And I'm not even necessarily planning for that to be the next 25 years, but at least I was planning for that to be the next 10 to 15, where I'd be approaching 50% or greater equity in the property. And then at that point in time, my concerns are pretty low about any sort of pivots or any changes that might occur at that point in time. So for me, it's just a way to build in a bit of a buffer. At the same time, like this year has been an unusual year for interest rates, right? So they're even lower than what I probably would have said in a year or two ago video where I'm like, we're at historically low rates. They'll never really get any lower than this. And here we are today. So in my general philosophy is I believe interest rates, well, actually, there's way too much to unpack there. But in our current economic environment and system, I suspect that interest rates will stay low for the foreseeable future. Whether they should or shouldn't, I think they will. So these days, I still kind of use 3.5 just because it actually works for a variety of reasons. One, because a 3.5% interest rate mortgage on a 25-year amortization works out to $500 per 100,000. So that's a really easy number for me. Like I can literally, someone can be like, hey, I'm looking at a building that's $1 million. I'm like, okay, that's an $800,000 mortgage. That's $4,000 a month mortgage payment. And so like, it just makes it so easy for me to be consistent with my mental math. But certainly, will you get a cheaper mortgage than 3.5%? Yeah, most likely you're going to.
Yeah, so that's what I factor in here. And then I have my monthly mortgage is call it $1,300. Our rent is actually $2,300 a month. So just on the mortgage portion of
And
things,
is that fully rented out, or are you planning to live in one of these units?
it's fully rented out.
Gotcha. Yep.
20%, and then we're kind of netting, call it $1,000 a month, just before taking into consideration other expenses.
Yep. And so, just breaking down the rent for me, what are the three types of units we've got again?
So we have 1 3-bedroom.
Yep.
That's renting for $950.
Okay. And is that fair market or below market?
So we believe it's looking at Facebook Marketplace, all that kind of Kijiji and those places. We believe it's under market now. We don't think it's significantly under market, maybe 10% or so under market, 5-10%.
Gotcha.
But we still think it's under market. Yes.
Yeah. Okay. Yeah. Keep rolling.
So $950 for the 3-bedroom, $800 for the 2-bedroom, which is upstairs.
Mm-hmm.
And the basement actually has a studio. It's rented out right now. That's at $550.
Okay. Awesome.
Gets you to your $2,300.
Yep.
And then the expenses that we factored in. So I have my mortgage, cash flowing, my mortgage aspect of it kind of give me a cash flow. But then we factored in a maintenance fund, which we kind of proxy at 10% of monthly payment, mortgage payment.
Okay.
Vacancy, 10% of our monthly rent.
Mm-hmm.
I have store removal at this from the owner or the listing that we just pulled up. It's about call it $300 a year. Lawn maintenance, another $300 a year. I kept property management blank only because as a first property, we're probably going to do the management ourselves. I know you're going to say that we should probably factor in property management, and I can into this model.
Mm-hmm.
So I can add a number if you want me to, but I left it blank for now.
Gotcha. Couple quick questions.
Sure.
On the maintenance fund, why is it a percentage of the monthly payment rather than percentage of the gross rents or like the building value?
I remember reading it on reading it in a book or a podcast where they used the payment, but is it a better proxy to use rent? Is that a better?
I think you'll find it more common. Yeah, okay. For like people usually. Again, what percentage they use, you'll find varies dramatically, but probably between 2 and 10% of gross rents, you'll find people will use for their maintenance.
Okay, noted. So I could change it now if you'd like, if it makes it more realistic.
Like I definitely would, just if I was in your shoes.
I'll do it now.
It would give me more comfort. And
perfect. So then I have my snow removal, lawn maintenance, property management. Again, I left it blank there, but we could add.
I'm just making sure, is that negative number being accounted for correctly in D3?
That's a good catch. I should make this negative.
Awesome.
Good catch there. We have a water tank rental. All 3 units actually have water tank rentals.
Okay.
The $30 a month. Heating oil, this is what we spoke about there, the one you pointed out.
Yeah.
That costs roughly $133 a month. Home insurance, we're proxying this at $170 a month.
Yep. Property
and school tax straight from the listing. And then mortgage. Okay. And so here's what I kind of want to talk to you a little bit about is, we ran the numbers, we're kind of spreadsheet warriors, but is it okay to be cash flow negative? This is a very pessimistic view in the sense that maintenance and vacancy, as we know, might not be applicable from a pure cash flow perspective. We might be, that might not come into play in a given month. But is it okay to be a little bit cash flow negative so long as you're building equity? Like, because my mortgage is being kind of fully covered, I'm still building, 12 grand of equity every year or so at these rates. Mm-hmm. Is it, like, from your perspective or your opinion, is that something like a good calculated risk?
Yeah. And I think this is one of the things that is really frustrating for a lot of people as real estate investors is, throughout the school system, society, life, oftentimes people are able to really quickly define for us what's a win and what's a loss.
Yeah.
And when it comes down to like whether I should invest in a property and what sort of metrics I should be looking at, it really is a personal decision, primarily focused on what your goals are as an investor.
Right.
If you're asking me, do I think it's like a smart financial decision to invest in properties that don't cash flow? Um, I think that there's a certain risk in holding a lot of properties that don't cash flow for extended periods of time. Now,
Mhm.
again, that doesn't mean that that risk can't be financially rewarding, but I definitely perceive it as a greater risk. So, for me, based upon my model, I really am looking for properties that are going to net cash flow every month, just because regardless of what happens, I can weather almost any storm, is kind of my underlying theory there, and I'll still benefit from a lot of the upside appreciation other hotter markets will have. Um, one other thing to be mildly aware of, and I don't think this really impacts you and this property in particular, but just in general, obviously, right now we're going through a relatively fundamental shift in society with how people live their lives and how they work. Um, we could continue to see more and more of an exodus to the suburbs or the exurbs, or even like just outside of the major metro areas. And again, for me, the idea of having cash flowing rental properties is more attractive because a lot of those higher, denser, more expensive markets are really counting just on the greater fool theory, which is someone will come in and pay me more for it. I
Mhm.
do understand what you're saying, though. You probably are making $12,000 a month or a year in equity pay down.
Yeah.
Um, so I think the biggest thing is just figuring out what are you trying to achieve overall. And what I would really focus on is, you know, is this property my practice property where I'm cutting my teeth? And this is essentially like paying for my university education or going to get my CPA license. Because in which case, making some money while learning, that actually isn't too bad of a gig, right? But if this is my business model, I'm going to scale this to infinity. Two things I would really just like question or challenge you on is like, one, how far in perpetuity can you do this, right? Like, what does that business model really look like? Are you refinancing every 3 to 5 years to pull out equity to solve the cash shortfalls? And does that project out well? At what appreciation rates does it project out well, right? And just kind of understanding some of those big pieces. But in general, what I'm going to say, if this is your first deal and this is cut my teeth deal, I don't think it's a terrible deal to get into. Again,
Mhm.
make sure you get a property inspection, do all your due diligence and stuff like that. And if I understand your spreadsheet correctly, you're losing 348 a month.
Yeah, so this is like what I call kind of a pessimistic scenario,
Yeah.
or realistic,
Okay.
whatever you want to call it,
And
all
so,
in.
yeah.
Yeah.
And so the one thing I'll state here, I don't like the fact you didn't include property management, but I think you were pretty aggressive on your vacancy rate. So overall, honestly, like your vacancy rate and property management blended together, I would say works out to an area where I wouldn't even argue with you. So I think like by having 20% between vacancy and maintenance fund,
Yeah.
that to me kind of gives enough forgiveness on the property management. So I feel like we're really looking at real numbers. The one thing we haven't discussed, tenants are paying all their own electrical.
So two out of the three are, and then the one that isn't is captured right here in the heating oil.
Okay. And so like are they paying their own electricity bill though? Like to keep the lights on and to run their laptop, they're paying that?
Yeah.
Okay.
Yeah. Yeah.
And there's no like water expense, or water's covered under property taxes or something?
Yeah, exactly. So water is covered under municipal property taxes.
Okay.
Yeah, and heating is covered under the tenants. The tenant pays for heating and electricity, so that's all covered.
Okay. Yeah. So overall, again, I'm not absolutely in love with the deal, but I don't think it's like a terrible deal. I do understand the long term upside you may see. Um, I would definitely just dig deep into the rent markets. Like I know you touched upon that you've checked out Kijiji, Facebook Marketplace, and stuff like that. I would just want to really be confident in my rents. And I would, again, I don't know Montreal well, but it's honestly a little hard for me to think that there's not potentially more upside in the rents, but maybe that's really just a Ontario thing. But we've seen rents skyrocket pretty much across the board this year. Um, so if there's a little bit more upside there, that again would make me more enticed.
Yeah.
One other thing, just I'm kind of going back through the photos on this property. Like that back addition, you know, if you're not familiar with construction and stuff, I would just make sure that I've got someone familiar with it just to like really pay attention to that back deck and just how everything's put together. Sometimes these back additions, um, at least here in London, Ontario, on some of these older buildings, sometimes they're built very robustly and they'll last 100 plus years. Sometimes they've been slapped together at some point in like the 50s or 70s or 80s before there was as strict a building code as what we currently have today. So um, I would just be mildly aware of that. But one of the big things is talk to the city, find out, is this on two lots? What sort of effort would it be to sever the lots? Um, if I was to sever the lots, would I be able to move parking into the front of where the current house is? Because like severing that lot might add a lot of potential to this and might add no value. So again, something you'll have to do due diligence on. But certainly, if I was taking this deal seriously, that's a couple of the things I'd want to look at.
Okay. Okay. That's good information here.
And then I guess finally, Ray, the only thing we haven't talked about is comparables. So I'm assuming that this matches up with roughly where what other properties sell for in this market. Does that hold true, or have you looked deep into comparables?
Yeah, so that's kind of twofold. The first fold is that in this area, the Montagne in Quebec, there really isn't many plexes. It's really like a suburbia with single family houses for the most part. So when looking for comparables, there's maybe three other plex sales in the last year or so, right? So it's a little bit hard to compare. It didn't seem too far off from what we saw. The second thing is that on the island of Montreal, prices are so expensive right now for plexes. Like you're getting similar rent you're getting here, but almost two, maybe 1.5, 2 times the price.
Mm-hmm.
So that's kind of why, as a pure investment type of play potentially here, that's what attracted us. And we're not factoring any appreciation. I mean, I factor in 2% a year just for kind of shits and giggles, but we're not kind of, there is a light rail system coming and all that kind of good stuff, but we're assuming that we're taking this on and it won't grow at all from an appreciation perspective. And just on equity buildup, we should be okay in 4 years. That's kind of the view we took on putting it together.
Yep. And then I guess the last thing is just I would definitely run a scenario at that 3.5% interest rate and just
Okay.
like, worst case comes to worst, 5 years from now, you have to refinance at that price point. Are you still going to be okay holding on to it? Because obviously, like the big thing here is if you were to buy a bunch of these properties, it's going to be difficult to retire off of these properties, right? Because they don't generate cash flow. Equity is great, but equity sometimes can be hard to eat.
Right. Right. No, that's it. And another aspect is we're kind of hoping that we're able to, if we run like a business, which is kind of like the ultimate goal here, can we increase rents? Can we get rid of the heating oil? Can we lower our home insurance? Like, is there ways for us to really cut down expenses and increase revenues to a point where we could cash flow? Because we're not far off from cash flowing. We're not too far off. We're not like, it's not a $2,000 here. We're almost there. I think it'll take a little bit of work though.
Yeah. Yep. So I think it's interesting. I guess like if I'm really nitpicking, like snow and lawn maintenance seems maybe a hair low, but nothing like if I had to guess, I would guess you're probably double that to actually get a local to clear the snow and stuff. But again, none of that makes or breaks it. So I guess I would try and dig deeper into finding a few more comparables if you've only found 3 or 4, because that stuff I don't like not having a lot of comparables. And I would look at as well those comparables, look at them not just as like triplexes to triplexes, but if there's duplexes or fourplexes or sixplexes, compare them as cap rates, compare them as price per unit, and compare them as gross rent multipliers. And hopefully, even with just a handful of properties, that'll help give you just a better gauge of exactly where your market is for multifamily properties.
So I have a question, Matt, real quick here.
Yep.
Should we factor in capex into our expenses, or is that part of repairs and maintenance?
So every investor has their own approach to this. For me, I kind of view as long as I've got a decent repairs and maintenance reserve, I view CapEx as a net neutral. So if I'm going to go drop a new roof on this house, I'm probably going to increase the value 1-to-1. So like if I spend $20,000 on a new roof, the property is probably going to be worth roughly another $20,000. So for me, unless it's a really big concern with cash flow, as in like I'm forecasting out my cash flow and I know things might be tight, or I don't have a lot of liquidity available to me, then that's going to be something that I'll factor into my cash flow projections as any large CapEx expenditures. But from a monthly projection standpoint, I actually don't on a lot of my initial numbers. Usually what I'm going to do is 555. Is that 555? Something like that. I'd have to pull up my spreadsheet for our large multifamily, but I think we usually do 5% repairs and maintenance. And this is once the asset's been stabilized. So for example, if I was buying your property, that wouldn't include things like the oil tank because I would get rid of that as part of the stabilization. If any of that back deck needed any work or any of the inside, all that would get done first. And then I might assume a 5% repairs and maintenance, and then 5% like 5% for property management, 5% for vacancy and bad debt, and then we kind of do 5% for lawn and snow removal. So usually what I actually do is 10% for PM, but I include snow and lawn in that. And that's kind of roughly, but as a real general rule of thumb, you'll find most rental properties operate at 40 to 60% margin or like a operating expense ratio. So just as a real ballpark, when you're trying to run numbers on a property that maybe you don't have a lot of data on, we'll usually just assume 50% of the gross rents are going to go to servicing expenses. And then obviously, as we get more data points, we refine our assumptions.
Got it.
Awesome, right? Well, I appreciate you jumping on this episode of Deal Destruction. Again, kind of in summary, if it wasn't your first deal, I would say I would keep looking for better deals. But if you're looking to really sharpen your teeth and just get a feel for real estate investing, I think you're going into this eyes wide open. So, if you decide to move forward, I don't see anything wrong with that. Obviously, do your due diligence, get a property inspection, talk to the insurance company about the oil heat, make sure everyone's on the same page about that. If people are interested in following along with you or this project, are you on social media? Are you willing to share that?
I'm on social media more on the private side for now,
Sure.
but it's all private social media. But if anyone wants to dig a little deeper on this model or any improvements or whatever, maybe I'll email you separately, Matt, and put my email address in the description, and they can send me an email or something.
Awesome.
Yep.
Sounds good.
Awesome. Thanks,
Thanks,
Matt.
Ray.
Thank you.
What are you saying? Not the time or the place, baby, it's not right.